Greetings, traders from all around the world. Thank you for joining me, Chris, on another In-Depth with Chris episode. Today, we're going to be covering Bollinger Bands. Bollinger Bands is a very popular technical analysis tool that is relatively simple to use. And when understood correctly, it can provide a very valuable edge over the market. Before we get going, however, I'd like to show you how to apply Bollinger Bands to your FinMark charts. All we're going to do is go up here to the top center where we're going to click the Show Indicators Options button. After that, the first thing in the center column is Bollinger Bands. We're going to give that a click and we're good to go. Go back up to the Hide Indicators Option button and we're all set. After that, the only other thing we really need to do with Bollinger Bands is going to be a matter of personal preference, and that's going to be things like adjusting the settings or the colors, and we're going to get to that in a moment. But from here on out, let's dive on into the information and work our way towards some strategies and learn a thing or two about Bollinger Bands. Now that we have Bollinger Bands on our charts and we know what we're covering today, the next step is to cover the basics. By the book. Bollinger Bands are a technical analysis tool invented by John Bollinger in the 1980s. And it is my personal belief that the indicators that have been around the longest and still show high degrees of use are usually showing those numbers for a reason. The Bollinger Bands are used to analyze the price and volatility of an asset in order to make informed buy or sell decisions. They consist of 3 lines or bands, which is 1 simple moving average and 2 standard deviations of that simple moving average. So essentially what we're given is a line in the middle, which will be our simple moving average, followed by a deviation on the top side and a deviation on the bottom side. Here we can take a proper look at what Bollinger Bands might look like on your charts. Naturally, this is the FinMark platform as we're already familiar with. If you're using something different, it may look slightly different, but the general idea and concept will be the same. We have an upper band and we have a lower band, which are deviations built around a simple moving average in the center. This provides us with our 3 bands, upper, middle, and lower. The idea is the deviations from the simple moving average represent the volatility range of the asset in relation to the price movements. You may be wondering, well, how in the world will the Bollinger Bands help me? Well, Bollinger Bands help us as traders identify possible price reversals by determining potentially overbought and oversold levels using standard deviation. The Bollinger Bands don't require too much analysis to arrive at an informed decision. The upper and lower bands widen when the market is experiencing high volatility, and then they get closer together and contract when the market is experiencing lower volatility. With these signals, the trader can better follow trends and basically time their entry more efficiently and trail their stop loss. Bollinger Bands are popular because they envelop market price and base their calculations on price as well. This way, traders can utilize them to decide whether or not to enter the market at a particular time. As we talked about already, Bollinger Bands show a measure of how volatile a market is. Now, volatile markets do offer more trading opportunities than those without much activity. More importantly, volatility alone can even predict the direction of the market as well as be a measure of its performance. In 2011, Crestmont Research was really able to staple in why we as traders should pay attention to volatility measurements like the Bollinger Bands provide us with. In 2011, they did a study where they were able to measure the historical relationship between volatility and market performance. And for its analysis, they measured the volatility of the S&P 500 using the average range for each day. At the end of the study, they were able to conclude that higher volatility signaled the higher probability of a downward trending market, while lower volatility signaled the higher probability of a rising market. Here we have monthly data comparatively to annual data, and both of them agree. The higher the volatility, the higher the probability of a downward trending market. The lower the volatility, the higher the probability of an upward trending market. Volatility definitely has the ability to be a double-edged sword. We need to keep in mind that while volatility can be a useful tool, it also presents significant investment risks since it increases both our chance of sharp gains, but it also increases our chance of a steep loss. That's where Bollinger Bands come in, however. By carefully analyzing all three bands and the rate of contraction or widening between them, we have a better chance of predicting ideal market entry and exit points, putting the volatility more in our side of the court. Most trading platforms will display their Bollinger Band settings very similar to this. The standard Bollinger Band formula uses a 20-period setting for the line which is in the center, followed by 2 deviations on the opposite side, which is going to give us the upper and lower bands, which are going to capture somewhere around 85% of all price data. We can always modify these settings to our personal trading preferences if we so choose as we get a little bit more experience with the Bollinger Bands. An example of this would be some traders actually prefer to calculate the SMA based on a 10-period average instead of a 20 because they don't want to have as large of a sample size of data going into the calculation of the bands to try to make the Bollinger Bands a little bit more present data based versus more historical based. If we really wanted to simplify Bollinger Band trading and what the Bollinger Band means when it's displayed on our chart, we can break it down into scenarios where we can consider the market to be expensive or cheap in regards to the current price of whatever asset we're looking at. If we take a look here and we see where price breaks near the top of the upper Bollinger Band, we can consider the market to be expensive because it's at 2 times the standard deviation and is far away from the SMA in the center. And conversely, if price nears the bottom of the band and breaks the lower Bollinger Band, it is considered to be cheap and is quite far away from the SMA in the center yet again. There are a large number of examples that I've highlighted here for you, as you can see moving along the Bollinger Band chart. Next comes everyone's favorite part about learning any new technical analysis indicator, which in this case is the Bollinger Band. And that is learning some strategies that traders are using on a daily basis with the Bollinger Band to potentially gather some profits. The first one we're going to talk about is the double bottom, and we have an example for you here on screen. The first thing we're looking for in the double bottom is we're looking for price to fall all the way outside the bottom band of the Bollingers. So we have our Bollinger Band here where we pushed all the way down outside, and we also had a large spike in volume during this time as well, illustrated on the bottom of the chart by the larger volume bars. So in order to pay attention to the volume, there's a number of ways to do it, but this is just simply a volume bar indicator, which most platforms have. Once we have our first bottom, so to speak, where volume spiked during a push outside the bottom Bollinger Band, we then want to see price rally back inside the bands and ultimately come back down to form our second bottom, hence the name the double bottom. Here is where that happened. Over here, we saw price spike back down and test the support created by the increase in volume around this area previously during the first bottom. So if we look from the left to the right, this area is almost equidistant. It's right around the same price point in the market. The market continued to hold this area, and on top of that, price continued to stay roughly inside the Bollinger Bands the second time around, which is a good sign for us. The reason is we want price to stay inside the Bollinger Bands when we're talking about the bottom because we are now anticipating price to rally. That means we're expecting price to go up, which provides us an opportunity to go long, and in this scenario, price did indeed continue to rally after creating our nice double bottom here. Now naturally, if we were to look for a double top, it is going to be exactly the same rule set, just flipped the other way around. Instead of looking for support to be built during a period of high volume after an initial extension outside, we're just going to be looking for the other variation. And if you can't imagine flipping the charts around, I'm going to do that for you. So here we go. Now, after we flip it, we have something pretty crazy going on here where we have our double top scenario using the exact same image that we used for the double bottom, which is why everything is upside down. This is intentional. I want to show you just how exactly similar these scenarios can be. If we imagine here for just a moment that our double top scenario is occurring on a chart that's not upside down, we just want to see price rally to a period where we're finding high volume as we break through the roof of the Bollinger Band. This means we're watching price push up beyond the topmost band during a period where the volume is high. After which, we want to see price fall back down into the band, coming back towards this area of high volume in order to test this area of resistance and create our double top. In this scenario, once again, it is exactly the same process that we go about the double bottom, but instead of doing it on the bottom of the charts, we're just simply doing it on the top. And also, our expectation is going to be flipped as well. What we do to one thing, we must do to the other. So naturally, here, we're actually going to be looking to short the market with an expectation that the market will fall. And in our beautiful inverse image, of course, naturally, the price did fall, going backwards here in our weird mirror universe. The next strategy that I want to discuss is one that is very valuable to be aware of just due to the fact that it occurs many times throughout the trading day on multiple assets anytime we apply Bollinger Bands to them. And this is called the squeeze. Not only is it a fun strategy to be aware of, but it's kind of fun to say as well. So essentially what we have going on here is we're looking for the volatility to come to almost a halt. We want the Bollinger Bands to get as tight as possible, which we had happen here. So once again, just a quick refresher, remember, the outside bands, this one and this one, are going to get closer together. They're going to narrow during periods of lower volatility, and they're going to get farther away, like over here and here, during periods of higher volatility. So for the squeeze, we want to see those bands squeeze closer together. So this does represent a period of lower volatility in the market, which is oftentimes something that precedes a large market move and increase in volatility thereafter. So we're looking for the squeeze in the market where the Bollinger Bands will generally come close together just like we have in this box here. It's usually quite noticeable because it's usually a much tighter portion of the Bollinger Bands than everything around it. Once we identify a period where the bands are squeezing together, we're simply waiting for the opportunity for price to show us where it wants to go. And what does that mean? Well, that means we're looking for price to either close or push outside the bottom of the Bollinger Band, which it did right here, or to potentially do it outside the top, which it did not do in this image example. So once price closes outside the bottom Bollinger Bands or outside the top Bollinger Band during this period of squeeze, we're usually looking to ride the market in that direction under the presumption that if the volatility is now increasing, a lot of times when the volatility increases from a standstill, it likes to maintain that direction. That's the general idea here. Of course, we always want to use general price action and outside knowledge when we are trading, not just simply going in blind just because the Bollinger Band got tighter. But the squeeze is a very fun piece of information to be aware of. It's a very fun strategy to be aware of in your Bollinger Band trading because, once again, it does occur quite often. As with all trading strategies and all trading indicators, there's always going to be limitations out there that we should always be aware of. With Bollinger Bands, one of the main limitations is if we're only using Bollinger Bands with no outside information, no outside price action or outside indicators, it may seem ideal to put in a buy order every time price approaches the lower band, or to put in a sell order every time price approaches the upper band. However, it definitely is a little bit more complicated than that to be a successful trader. Just because the market is deemed cheap or expensive doesn't automatically mean that we should enter or exit a trade right then and right there. It's common for traders to use other indicators such as the RSI to help confirm some of the signals that the Bollinger Band is providing us. Even if we're not using any outside indicators, using common price action and chart patterns can be very valuable to helping increase the accuracy rate that we achieve while trading with Bollinger Bands. And I'm back. Or did I ever leave? So the bottom line here is Bollinger Bands are a valuable tool. As we look through the charts, there's going to be a lot of situations, just like we already discussed with some of the images I already showed you guys, where you're going to see some pretty awesome highlights that the Bollinger Bands provide, giving us some awesome buy entries and some awesome sell entries. But as with all things, we don't want to use them by themselves, and we want to use common sense when we're trading. Bollinger Bands are a fun tool to use, and they're relatively simple, and also they're very clean on the charts, which I'm a huge component of myself. I've been a fan of Bollinger Bands for quite some time myself, and I hope that you'll find some value in them as well. But in the meantime, I look forward to seeing you in the next one, the next In-Depth with Chris, or perhaps the next survival guide. But either way, happy trading everybody. Please make sure you click the like and subscribe button below, and I'll see you in the next one. Cheers everybody, over and out.